This is Back Roads of Illinois server to farmers and ranchers in central Illinois and the Midwest. Today is edition of Back Roads of Illinois. We were bringing you lasted for farming sources and information sponsored by AgriGold. We were glad you're here on a Thursday afternoon for today. I am Cesar Delgado. I am your host of today's program. We were talking about the corn ratios on today with Jason Franklin from the University of Missouri. Yes, we're seeing more corn acres from the Department of Agriculture. We need to know about the corn ratios on today with Jason Franklin. Then we were talking about the grains markets for right now with Naomi Blom from TotalFarmMarketing.com. On the Markets Club podcast, we were joining with Brian Hoops from Midwest Solution on the fundamentals and demand for the beans, and we were joining with Christina Vanon from Vanon and Company and Duanya Bussey from Bold Marketing LLC on today's World Supply and Demand Report from the Department of Agriculture. The podcast is coming on Friday. I am not a commodity broker in markets analysis or an economist from some big schools in the country. However, trade deficit will be hurting for our farmers and ranchers. We're hurting our economy in the United States. However, it seems like not great for us and our family, our economy with trade issue. Again, I am not a commodity broker and stockbroker, an economist. However, our economy is hurting. Otherwise, this is your rural news sponsored by AgriGold. The World Supply and Demand Report is coming out for Tuesday. It's unchanged for the yields trends in the report. In Missouri and Illinois, Arkansas, West Tennessee, they are dealing with major flooding in the Mississippi River with some tornadoes damaged. Finally, next week will be a deadline for crop insurance by April 15th in central Illinois. That's your rural news brought by AgriGold. This is your commodities markets update for this afternoon, sponsored by Kyle Bumstead from Allendale Incorporated. May corn is up at 3 to 6 cents for this afternoon after the World Supply and Demand Report on today. July corn is up at 4 to 6 cents. September corn is up at 9 to 5 cents. May beans are up at 5 to 4 cents. July beans are up at 5 to 9 cents. Kansas City wheat is lower for today. KC May wheat is down at 8 to 6 cents. KC July wheat is down at 9 to 5 cents. Chicago wheat is down for today. Chicago May wheat is down at 3 to 10 cents. Chicago July wheat is down at 3 to 9 cents. Livestock markets are down more today than yesterday. April cattle is down at 8 to 6 cents. June cattle is down at 9 to 4 cents. May feeder cattle is down at 9 to 6 cents. July feeder cattle is down at 3 to 4 cents. Lean hogs is down for today as well. The April hogs is down at 5 to 3 cents. June hogs is down at 8 to 5 cents. This been your commodities market. I'm going to talk about the grains markets, especially with these prices for right now with Naomi Blom from TotalFarmMarketing.com. How are you today?
Well, I'm doing great because I've got green on the screen with higher corn and soybean prices.
Okay, let's start with the numbers for the world supply and demand report. What is your thoughts on that?
Well, I really loved today on the report that corn carryout came in lower than the average guess. This is what I thought it should have been 2 months ago, and the USDA is just getting caught up now. So they put corn carryout at 1.465, down from 1.540 last month. That's a big drop. I liked that they increased demand for exports, and they did reduce the feed demand a little bit, which makes sense with less animals on feed and the bird flu and all that. But I really liked that number today for corn. Now, to me, it looks like next target higher on nearby corn contracts could be $5. Then there'll be some resistance there. But now we're set up that we could really have a weather market going forward if there's a delay in planting or some drought concerns this summer. So I am really excited about corn. Of course, I'm mindful about bigger new crop acres coming, but we got to get them in the ground first. On the soybean side, today the USDA on that report did lower ending stocks just a little bit. Last month we had 380 million bushels, and now we're at 375 million bushels. So they did some adjusting where they raised imports a little bit. They raised the crush demand a little bit. No change to export. So that means they kind of said that they were just using the current information that they had, and the tariffs hadn't really gone into play yet, and some lower seed numbers. But the ending result, we had lower ending stocks for soybeans. So soybeans now between lower U.S. ending stocks and the lower U.S. acres getting planted, that soybean market starting to get a little bit of a fire underneath it. And charts are looking stronger. Seasonally, we're in the window where usually corn and soybean prices will grind higher throughout the month of April. And then that rally sometimes comes to a halt the first week of May. But hey, we're going to take it. It's good news. And grain prices are up for corn and beans.
What was on the CONAB from Brazil for this morning? Know me?
Yeah, on the CONAB numbers, I got to go back and look at it. I've got it handy here. CONAB numbers, I'm just going back to my notes from this morning. On the corn side, they actually raised production just a little bit. And USDA, though, made no changes to production today for corn or soybeans in Brazil or South America. So that's a little bit more of a wait and see thing. The weather in Brazil so far is okay, but they're at risk of drying out, which would harm that second crop corn, the safrinha crop that's growing. So that's what we got going on there.
How is the beans futures with the fundamentals?
So the soybean market, the fundamentals for old crop are supportive for now. So we have not yet lost any export demand for old crop, and we are still shipping out product every week. So that's the good news. Ending stocks are snug. And if the US plants 3 million less acres of beans like we're supposed to, there's no room at all for any weather error this summer. Of course, we're waiting to see if we lose any export demand to China. Of the beans that we export, China takes about half. So it's about a billion bushels of beans that they buy from us overall. So there's always some risk that they could reduce some of that, which would offset lower production. But I don't know. Bean story is starting to pick up news. It's starting to pick up pace. The charts are looking friendly again seasonally. Beans usually work higher here for another few weeks. So I'm a little supportive at the moment for prices, barring any new twists and turns on the tariff front.
What happened with the technical aspects on soybean futures for this week's trade?
Well, we're in the process of putting in a big hook reversal to the upside. Last week, beans on a weekly chart posted a bearish key reversal on the tariff news. But now that we put the 90-day pause on tariffs, except for China, bean futures are just about 10 cents away from taking out last week's bearish reversal and actually putting in a bullish reversal. So it's looking better. We have, of course, one more trading day to go this week. Anything is possible, but it looks a lot better than what it did last week. I can tell you that.
What is your final thoughts on the corn acreage?
I would say right now, I agree with the number that's out there that American farmers will plant potentially about 5 million more acres than they did last year. But now that the Ohio River Valley is such a flooded mess, I don't know. I'm curious to see what happens because those folks there, they like to plant beans early. Is it going to be too flooded to even get the corn going? And so I'm a little curious if there's going to be any last minute maneuvering one way or the other, but right now I can buy into and agree with the acres that are there. And then, the reality is that if those acres come to fruition, if we have average weather, if we have an average crop, it'll help alleviate the tight ending stock supply, but we're not going to be back over 2 billion bushel carryout. So it all comes down to weather and the tariffs. And that's what we're going to be looking at over the next 3 weeks for sure.
Thanks, Nomi.
Well, Caesar, you are welcome. It's always a pleasure to visit with you on the markets.
We've been talking with Naomi Blom from Total Farm Marketing, One Back Roads of Illinois. We have a conversation about the corn ratios on today with Jason Franklin from the University of Missouri. Jason, how are you?
I'm doing good, thank you. How are you?
Can you tell us about the corn ratios on today?
Yeah, so the hog to corn price ratio is a historical indicator of hog profitability and maybe a precursor of cyclical changes in production, given that feed costs are a primary component of hog production. For instance, if you had $4 a bushel corn, you need $80 hundredweight hogs to have a ratio of 20 to 1 or just 20. And so target levels have sort of evolved over time, reflecting the declining share of feed in total costs of hog production compared to other components such as like building equipment and labor. And so like back in the 1950s, for instance, you were looking for a ratio of 14 to 1 to be sort of like a profitable target, or in the 60s through 80s, maybe 18 to 1. And today we are looking for that ratio of 20 to 1, basically. And it's kind of consistent with what we've seen come out in that most recent Hogs and Pigs report. 2023 being one of the worst in record for or in memory for hog profitability. We saw hog to corn price ratios around 12, 13, something like that. And then kind of pulling up into 2024, uh, around 17, 18, and now for the last 3 quarters of 2024, we were actually above 20 for that hog to corn price ratio, with the first quarter of 2025 being at like $19 or 19.5, something like that. So it's kind of rounding up to 20. So we're kind of on the cusp there of where it would suggest that producers might be thinking about expanding. And while uh, farrowing intentions were down for the spring, about 2.5%, they're up about 1.5% for the summer.
Do you have any concerns about these ratios for right now with the hogs markets?
Yeah, so I mean, we're kind of like right at the level that it's kind of profitable enough to maybe incentivize some thoughts about expansion. Even, the reality being with 2023 being such a tough year, there might need to be some more time for financial healing from that. Um, that sort of target ratios recently between 15 to 20 are kind of reasonable. You get down there to 15 and the producers are financially strained. So, like I said, in the first quarter of 2025 here, we're not quite at 20. If we kind of transition down to the lower ends of that again, then that'll certainly hold off expansion. But if we can keep it up above 20 for a few more quarters in a row, that'll give greater incentives for producers to expand. Of course, the big question becomes what happens with all this talk of tariffs and what will actually go on there.
What is your thoughts with today's trade deficit with these ratios, Jason?
Well, I mean, so the discussion about the trade deficit, this is fueling the thoughts of putting these tariffs in place, and it is a potentially double-edged sword. Of course, during President Trump's first term, he wanted to protect domestic steel aluminum production, and of course, China had some retaliatory efforts that limited maybe some of the exports of pork from what they could have been during the time that China had the African swine fever so bad. So it could have a similar effect again if that stays in place on pork exports to China. At the same time, this is an imperfect indicator, the hog to corn price ratio. Like I said, corn prices are a major cost of the feed component, but the overall cost of hog production has increased with other aspects such as the buildings, equipment, and labor. And then additionally, soybean meal could be part of that as well. And so the soybean market is a little bit more uh, affected by exports for us than corn is. So the degree of limited substitutability of soybean meal and corn in feed rations would come into play as well.
Can you explain to our audience about grains markets and the hogs markets with these ratios?
Well, yeah, if the retaliatory tariffs would come in on China's side there, limiting exports, for instance, of soybeans, there might be more soybeans available to go into that feed ration for hogs, but there's limits to that. Typically, we have more reliance on corn in those feed rations for hogs. So there's a limited amount of substitutability there. But what you would be looking at with that would drive up the price of feed, with it being a big part to corn as a feed component, and then drive down the price of hogs, squeezing that corn to hog price ratio to lower levels that would not be suitable for expanding the hog herd, not indicating
What
profitability
is
for
your final
producers.
thoughts about in the future with trade impact?
Well, it's anybody's guess how this works out, but we can Kind of hope that this is being discussed, kind of being used as a negotiating tool. Of course, right now we've got a little reprieve from when the proposed tariffs would go into effect, and that becomes kind of a question of when do threats become credible if he's using this as a if President Trump is using this as a negotiation tactic. And economists like free trade, so ideally, the best situation would be for fewer tariffs to come into play for this hog to corn price ratio. I think to end up giving us profitable opportunities for hog production and to spur expansion of the herd.
Thanks, Jason.
Thank you.
This is Jason Franklin from the University of Missouri. Thanks to Naomi Blom from TotalFarmMarketing.com and Jason Franklin from the University of Missouri. This has been Backroads of Illinois. I am Cesar Delgado. You have a great day.